And we'll start, as usual, with our short video for that.
When you check your investment portfolio, it's so easy to fixate on that one big number, right? The total return. But as exciting as that number might be, it really doesn't tell the whole story. For anyone who's serious about investing, the real question isn't just what you made, but how you made it. And that's exactly what we're going to break down today. So, let's say you had an absolutely killer year. You're up 20%. That's awesome, right? But here's the kicker, the real question. Can you do it again next year? Was that massive gain the result of your brilliant, repeatable strategy, or was it just a rising market that lifted all boats? Or hey, maybe you just got plain lucky. Well, answering that question, that is exactly what performance attribution is all about. It's about getting to the why behind your returns, because that, my friends, is the absolute key to building a strategy that can deliver real, long-term, and most importantly, repeatable success. I want you to think of performance attribution as being like forensic accounting for your portfolio. Seriously. For any pro investor, this isn't some optional exercise. It's their scorecard, it's their audit trail, and it's the coaching tape they review over and over to get better. It's how you separate genuine skill from just pure dumb luck. Okay, so let's pull back the curtain and unmask the forces behind your returns. In this little investigation of ours, we're on the hunt for 3 primary suspects, and each one tells a totally different story about your performance. First up, we've got Alpha. And honestly, this is the hero of our story. This is the return you generated because of your superior insight. It's the profit that came from your active decisions, like picking that one winning stock that everybody else completely overlooked. This is your skills shining through, and it's what every active manager is chasing. But let's be real, it's something very few can consistently pull off. Okay, next up is Beta. Now this is the return you get just for showing up. That's it. If the entire market went up by, say, 10%, and your portfolio also went up by about 10%, well, that's your beta. You just rode the wave. It's nice, for sure, but it's not a sign of your unique genius. And then there's our third suspect, noise. Or, just plain old luck. This is the random, one-off event, a surprise merger, a sudden tweet, whatever, that gave you a boost but is totally unpredictable. And this is where our own psychology can really mess with us, because it's so easy to mistake a lucky break for your own brilliant insight. A pro knows the difference. And right there, that's the core conflict, isn't it? The big battle for every single active investor. Are your returns coming from your own repeatable skill, your alpha? Or are they just a reflection of what the market did anyway, your beta? Knowing the difference between these two is, well, everything. Okay, so how in the world do we actually figure this out? How do we know what's really driving our returns? Let's get practical. It's time to open up the Investigator's Toolkit. This is the playbook we're going to use to interrogate your performance. Any good detective knows it's all about asking the right questions. So we start by asking, were you just in the right place at the right time? Like, did you bet on the tech sector and tech just went nuts? Or was it your specific stock picks inside that sector that made all the difference? Did you nail the market timing, getting in and out of the perfect moments? And if you're investing globally, how much did the currency exchange rates help or hurt you? But hey, just like in any good detective story, there are always plot twists. There are hidden factors we've got to look at. It's not just about that final number. We have to look beyond the bottom line to really get the full story. And wow, this quote just says it all, doesn't it? Earning a massive return by taking a stomach-churning, insane amount of risk doesn't make you a hero. It just means you're a gambler who happened to win this round. Real skill is about generating returns efficiently. And this gets to an absolutely critical point. A huge return that you got by taking on huge volatility, that's not real alpha. Professionals measure this with things like the Sharpe ratio. Just think of it like a simple score. It tells you how much return you actually generated for every unit of risk you took on. A high score is great. It means your returns were worth the risk. It's the difference between smart investing and, well, just playing with fire. All right, you ready for another plot twist? Because there is a silent partner in your portfolio, one who gets paid whether you win or lose. I am, of course, talking about management fees, and these things can be a huge drag on your performance, quietly eating away at your hard-won alpha. So, let's just walk through a quick story here. Your annual statement shows up. It says you got a fantastic 12% gross return. You're feeling like a genius, right? But then, oof, we got to subtract that 2% management fee you paid your advisor for their expert active management.
So that leaves you with a 10% net return. This is your take home. And hey, it's still a really solid number. Most people would just stop right there and be happy.
But this is the crucial step. We have to ask, okay, but what did the market do? And in this case, the market benchmark, let's say the S&P 500, it returns 9% all on its own. And just like that, the picture becomes crystal clear. Your net return was 10%, but you could have gotten 9% just by buying a simple, cheap index fund. The real alpha, the extra value you paid for, was just a single percent.
And this forces you to ask the really tough question, the most important one really. Was paying that 2% fee worth it just to get an extra 1% of performance? Or could you have just captured most of that return yourself for a tiny fraction of the cost? That's the kind of brutal, honest truth that this whole process uncovers. Okay, so let's bring it all home and deliver the final verdict. Understanding all of this, the alpha, the beta, the risk, the fees, this is what separates the amateurs from the pros. This is the professional's scorecard. You see, at the end of the day, performance attribution isn't just about grading your past performance. It's really about building a better future. It tells you exactly what part of your strategy is working so you can double down on it. It tells you what's not so you can fix it. And it tells you what was just dumb luck so you don't make the mistake of counting on it again. Look, the hallmark of a truly great professional-grade investor isn't just about getting a good return. It's the relentless pursuit of understanding the why behind that return. So next time you open up that portfolio statement, don't just glance at the bottom line. Dig deeper. Find the story behind the win.
Okay, so let's go back to our discussion on performance attribution. And the first thing we need to remember and we need to consider is why it is an important issue and why we should care about performance. Not just the headline performance that we get, but how did we get that performance? That is the critical issue. And if I don't mind, we're going to go back to our numbers from yesterday when we were looking at the performance of the SADIF stock picks in the US. And of course, we have the first thing we need actually is to have a number that gives us an idea of how well or how bad we did. Okay, so that means, of course, that we always need to have a benchmark. So we have our portfolio and we have a benchmark. In the US case, we choose the SPY, which is the ETF that replicates the S&P 500. And so that is clear. And of course, we need to know how much we invested and what is the current value of our portfolio and what would be the same comparison with the ETF if we invested the same amount and what would be the current value of a portfolio made of a single asset, which in this case would be the ETF. Now, if you look at these numbers here, you see already here a little problem of interpretation because we were supposed to invest the same amount we invested in SPY. You were supposed to invest the same amount in our portfolio. But here we have 3,104,000 and here we have 3,360,000. So really, what did we invest? So if I'm comparing our current value to the invested amount here with this one, it gives me a return of 22% if it's in US dollars or 23% if it's in FAI. And the SPY gives me a return of 698 in US dollars and 696 in FAI. Okay, so which of these returns shall I consider? Or how should I look at this return? So the first thing is that probably I need to adjust my return. And I adjust it for this value because, in fact, what I have here is that I didn't invest just this amount. I invested this amount. So if I divided this amount by this one, the actual return was 13.4%. Well, still well above the benchmark, the ETF, but not a big 22% as I had here. So which number should I consider? Right, so I obviously, in our platform, you'll see that we look at this first number, because in fact, what does this reflect is the so-called averaging of the values resulting from the fact that we sold some of our stocks. You remember we have sold something like, I think, 14 or 10 stocks, and that money was reinvested. So that means that we have already realized some of the, or most of the losses have already been realized. You see, so they have been realized, and therefore that's why this value is smaller, because it's already this value minus the losses that we have already realized. So this gives us an illusion of a better performance, as you see, and that's one of the reasons why this is not probably the best metric to use. So if we want really to have a headline number to use, we have to take into account not only these factors, but also the timing and the amounts invested every month on this on the portfolio and on the SPY. And if you look at the money weighted return, then we have a bigger number in US, both in US and in FA. It's actually quite similar, so there wasn't much change. And likewise, if you look at the time weighted return, again a big number against a smaller number. So shall I say that our performance was, if I use this number, I would say that our performance was basically twice as good as the benchmark. If I use this number, you see, I would say that was 3 times the performance of the benchmark. So this is a very important issue. And from what we said yesterday, this is the proper way, is the correct way of measuring. So if I look at the money weighted return, this is the best measure. So it's not this one I get in the platform. It's not this one. It's in fact, this is the best measure that I can use to. But also, as I mentioned to you, it fluctuates a long time. So I need to look not just at this final number, but also some intermediate measurements during that same period. Okay, so let's agree that this would be the final number that I would look. But now I need to discuss or to understand, how did I get this result? How did I get this result? Was it by taking more risk? Was it by being better at selecting the sector, being better at selecting the individual stocks? Was it better at managing the portfolio? So we need to somehow deconstruct the return, and we can use the traditional way used in the so-called modern portfolio theory, which is highlighted here in this slide. You see, I can decompose the return, the portfolio return, into alpha, which is basically a measure of our performance, and the contribution of the market should be met, and then the luck factor or unlucky factor that we can see, basically the noise. And we can do that as well in our platform. If you look if you go at our platform and go to the selection section, okay, I will just select here a strategy for the US, for instance, just to illustrate, because we actually is something we need to change in our platform. But let's say that I was using this strategy, and for 1 year, which is actually, so I just need to change this to 25, go back to March, and okay. All right, so if I use this strategy last year and build a portfolio like that, I can, just to illustrate you the results. So I would have this portfolio. It's funny enough, one of them is the one that we have now as a cell in our portfolio. But you see, we have a fantastic return on this one. But I can now here find ways, the measures that I was mentioning a bit a while ago. You see in our slide. So let's see that I had chosen the best weighting method would be capitalization. I have a tremendous return of 122 because of a specific stock here, actually two of them. And so I'd have this fantastic, but even if I choose a equal weighting, I would still have a very good one. Let's say 73%. So this is a very exceptional return. Or if I use the SMR, again 67%. But how about this? How should I read to these numbers? So if I look at risk adjustment, what I see is that well, let's use the first one. So risk adjusted using Sharp would be 26.5. Again, it would still be a very good return. The contribution of the market, sorry, we are still dealing with the question of addressing the risk issue. So you see that I didn't take substantially more risk than the market AF. You see, the market AF risk was 15% using Sharp. The Marx Mendes will be exactly the same, but here we took a bit more risk. So, but of course, the difference between 14 and 74% is huge. So this more risky selection actually made a huge impact in the huge increase. If we look at the other measure of risk adjustment, which is the so-called trainer ratio, this one would be again still basically double the same as the market. Again, certainly in this portfolio, I would take more risk than the ETF. So that's no doubt of that. Whether that risk was worthwhile, in the end of the day, it proved to be worthwhile. But I need to discount maybe. So if my risk here was almost twice, I should divide this by, say, by 2, and then it would be a return of 35% if I adjusted it for risk. So in fact 26 if I use the Sharp ratio here. So risk-wise, yeah, certainly we would take more risk with this strategy. In terms of our skill is measured in terms of alpha. So in terms of our alpha skill, the skill was still strongly positive, so 80-22. The contribution of the market was bigger, 1.14. And finally, what is the error term? The error term here it means that was about so the R square here was in this regression was 46%. That means that I had 54% can be attributed to unknown factors, so that it's not explained. So our performance is not explained either by alpha or beta. You know, I have 54% of that return that is not explained by either our skill or by the impact of the market, but really we don't know what was the reason, what caused that. So this is one methodology that is often used. This methodology is also used often to or can be used to measure whether the results can be attributed to the selection of the stocks or to the timing of buying those stocks. Usually we do when we do this regression analysis, where we add two dummy variables to take into account the timing and the selection of the stocks, and then we try to see whether the manager contribution was more because of his selection capabilities or of his timing capabilities. So we can also do that type of. In fact, there are a number of methodologies to try to identify the root causes of a given performance. This is the traditional way that we do it. We can do it using our platform, but there is also an alternative that we can use, which is looking at the relative performance of the portfolio relative to the market. So what we call market beating multiplier. And what this measures is basically a ratio between the assets of the portfolio. This basically a ratio between the assets of the portfolio at the end of the period, in this case after 13 months, divided by the asset value or the NAV, let's say, with better say write it NAV here. Oops, the SPY here, also at T. So if this is 1.15 as it is here, that means that $1 invested in our portfolio would be 15% more than the value of the same dollar invested in the benchmark, in the SPY. So this is what we call market beating multiplier, and you see it's a different measure, because then we can decompose again, trying to understand why did we get this fantastic result here. What to which can we attribute these results? The first thing is to look at we separate the performance between two periods when the portfolio did better than the SPY, and this is period 1. In period 2, when the SPY did better, so then the portfolio. So basically, that's how we separate, and then we take the ratio between the two performance. And of course, in the first period, the performance of the portfolio was much higher, and by this factor, 6.5. While in the second period, when the SPY outperformed the portfolio, the value is obviously negative, but is not so high, it's just 0.6. So I can here then identify, funny enough, during this period, the ETF had more or less the same. This is not actually exactly equal. If we took more decimals, it will be slightly different. But basically, the ETF return would be this one during this period, during the first 12 months. And so I know for sure that the reason why we did so well was because we outperformed 61.5% of the months. So throughout the period, we outperformed the SPY basically more than 6 times out of 10. And likewise, when we outperformed the market by a large margin, and since and therefore we have this multiple very high, 6 times. And when we underperformed the SPY, we underperformed by a much smaller margin, so it's much lower. So this is again an interpretation, is a breakdown of the reasons why we did much better than the SPY during these 12 months. And then we can also look at the elasticity of changes in these factors. So an increase in the period here was 13 months, and had an elasticity of 0.14, not that big. But the important thing is that these two factors, both the relative performance of the during the outperformance period are very high, so 0.27, and this is 0.38. That means 1% increase in our excess return. So one from 61 to 62.5 would have an increase of 0.38 on our market beating multiplier. So this is another way of looking at how we are doing and why we are achieving this kind of result by looking at the composition of the factors that explain this change. So this is one again another method why we can break down the results. We don't look just at the headline values. We don't just look at the headline values, but we try to understand how we got these values. So that's very important indeed. And the reason is, why should we go through this trouble? The reason is that we learn a lot about how we are doing, and we basically realize how much was just a poor lake or just happened, and how much is due to our own skill.